Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic, no one is raking up cash and setting fire to it. Michael, what in the world do you mean by this?
Dallas, when I finally leave this earth, I want to be known for two quotes. The first one, of course, the listeners will know. When you retire, when you stop getting dressed to go to work, your money has to get dressed to go to work for you. That's number one. The second one is a quote that I believe that I coined just after the global financial crisis. Because I said it to someone. Now, I don't know if I did or if I heard it somewhere or I didn't.
I feel like you probably heard it somewhere, mate. We've had these conversations about other things.
The quote is, no one is raking up cash and setting fire to it. So I'll explain that in a little minute. A quick Google search yesterday.
Couldn't bring up any other
Couldn't
result.
bring up. Yeah. Google more or less came back and said, what the hell are you talking about? This phrase isn't recognised anywhere. So I believe I've coined the phrase.
Okay. What do you mean by the
phrase? I believe that I
coined
it just after the global financial crisis when I was talking to a client at the time. Anyone listening, if you can prove me wrong and find where someone else has said it, then certainly feel free to do that.
I thought you were going to say where you've heard of someone actually raking up cash and setting fire to it. I have actually heard about the, I think it was in the inflation, was it the German Republic when the Deutschmark went to some astronomical figure, and apparently the amount of the cash that you had couldn't even buy firewood. It was cheaper just to burn the notes and use that for firewood. But what you're talking about here when you say no one is raking up cash, we're not talking about the Zimbabwean dollar or the Deutschmark. We're talking about normal money here.
What I'm talking about here is you always hear it. Yeah. You always hear it in the financial media, the scaremongering, that spending is down and savings are up. Yeah. Now we haven't seen a lot of that lately, but that's what you hear. Spending is down and savings are up, and that's portrayed somehow as that's going to be significantly detrimental to companies' profits.
Well, what you actually hear, you don't even hear savings are up. You just hear spending is down. So when you often hear this in economists saying consumer spending in this area or this industry went down by 10% last quarter off the back of reduced consumer confidence, and so there's always the talk about when spending is down and how that's the end of the world.
You hear that it's the end of the world for companies. Now, what I also heard in the global financial crisis, every day there was a report where $1 trillion had been lost,
wiped off the
value of these share prices, and $1 trillion had been wiped off the value of American homes. And what got me to saying no one's raking up cash and setting fire to it is that the money actually hasn't been lost. What's happened is that the value of American homes has fallen by $1 trillion. Yeah. But if I sold a house that was worth at the time $500,000, and a year later someone's bought that house off me and that house is only worth $250,000. What's reported is that there's been $250,000 lost. Now someone's lost $250,000.
Someone's gained
$250,000. I've sold a house that is now worth only $250,000. Yeah. But I actually happened to sell it a year before and it was worth $500,000 then. Yeah. So I'm up $250,000.
Yeah, but that doesn't show up anywhere.
That doesn't show up anywhere. Yeah. So that's where I came up with this saying. Yeah. Unless I didn't. And I just heard it. but I just thought it's what's being reported in this global financial crisis is that there's been cash being raked up and set alight. Yeah. And no one is actually doing that. So
no, and it's sort of implied that assets are disappearing, or the fundamental nature of the thing that you own is disappearing, and that's just not what's happening. Like you said, whether it's house prices or company prices or whatever, when there's a drop in that, no one's that doesn't disappear. If the NAB share price goes from $30 a share to $20 a share, as you just said, the same thing happens. The person who bought it for 30 and sells it for 20, they've lost $10. But the person who buys it for $20 instead of $30, they've got the $10 effectively. They're in, as a whole economy, we're in the same sort of boat there.
We're in the same boat, and what actually happens during a normal recession is that money goes into hiding for a period of time, and it comes back out later on. Now, when it goes into hiding, that's reported as kryptonite for companies, and it's reported as these companies are going to go broke, because spending is down. So, number one is that if spending is down by only 5%, which is a fairly deep recession, for every $100 that was being spent, there's still $95 being spent. Next week. That's what would be referred to as a deep recession.
So that's, I guess, step one of that is that we tend to assume that in a leaner time, or when spending is down, as though no one's spending any money, and that companies are going to go broke because no one's spending any money at all. When really what's happening is just that their revenue has gone from $100 million to $95 million. It's been constrained by that amount. Their profits are probably down a little bit as a result, but they're on average, they're probably not going to go broke.
Let's put this into more realistic terms. So, for every household that spent $100,000 last year, if spending is down by 5%, they're only spending $95,000 this year. Now, again, that's portrayed as deadly for companies, not deadly good, deadly in a bad way. But that $5,000 still exists. The fact that I haven't spent it means that I've saved it, and that money's gone into hiding for a period of time. Now that money comes out of hiding later on. If I do that for 3 years, for example, there's an extra $15,000 that I would have spent in those last 3 years that I now have. And rest assured that money comes out of hiding. It always does. So when people get the confidence to spend again, what happens is that they actually inject that $15,000 of saved money back into the economy. Now, that's very good for companies. My point, I guess I'm labouring on it here, but companies also are very, very good at actually rolling with the times. So what happens when spending is down, they suck in a little bit and become a little bit leaner, and they
cut the costs.
Cut some costs. They close some unprofitable supermarkets, or whatever they do. The staff numbers come down a little bit. Whatever they have to do. Now, when people are actually spending again, that's when they're very, very adept at actually dialing that up.
And
really, really quickly to capture that money. And the financial media continues to report that if spending is down, number one, there's been money lost, as if someone raked up cash and set fire to it. And number two, they portray this as something that's going to be one of the worst things ever for companies. Companies for since the dawn of time, another classic line of mine. But since the dawn of time, companies have actually been able to move
quickly
with the times.
To that.
And the ones that don't, they go out of business. However, the demand for whatever they sold doesn't go out of business. Doesn't go away. So someone new coming up, another new company coming up to take its place, quickly captures that market. Now, again, without trying to digress too far, that's why you need to be diversified. I mean, that's why we tell people they need to be diversified across a massive, broad group of companies.
But I think the other way to think of this is that, again, if you bring it back to the household level, when people say consumer spending is down by 5%, the average person who comes and sees us at 55, a part of their plan over the next, say, the last 10 years of their working life is to save some of their earned income every year and contribute it into super and that kind of thing. So, but the point of why they're saving that money is to spend it in retirement. It's not, they're not saving that money so that they can put it in gold coins and swim through it like Scrooge McDuck. It's just deferred spending. That's all it is that they're saving money for the next 10 years so that then they can spend more or spend a consistent amount throughout their retirement. So
that's a really good point. I mean, we had clients, of course, that are putting money like you said, aside every fortnight in 2020. Now, they also had money set aside to go on a world trip that they couldn't do because of obvious reasons.
Yeah.
Now, so they've got extra money that they were able to put into their superannuation. It's going to come back to them at some stage.
That's
like
exactly right.
when they're able to travel again.
Yes.
They are able to effectively, they're in a better position to be able to fund.
Well, that's the whole thing, isn't it? Like whether they go on one trip now or they are forced to save that money and they can't go. They don't travel for 10 years and then they go on 2 trips because that money has built up that much. It's not going to go. It's not going to go anywhere. And what would I guess be considered worst case scenarios, even if they don't ever get a chance to spend that money, or they save that and it continues to grow all through their retirement. At some stage, that money is going to get handed over to their kids or to somewhere, and the money is going to flow back into the economy from somewhere.
Absolutely. So it's never being lost.
No,
it exists.
Yeah. It
just goes into hiding for a period of time.
Yep.
And it comes out at some stage. Now, rest assured that money is going to come out at some stage. Like you said, whether it's 20, 30 years before it's passed down to their kids, who I can tell you are just itching to do a renovation on their house with your hard-earned money that you've put aside for. The money from poor old mum and dad's deceased estate comes down to the kids, and from what we have seen, kids are interested in doing renovations and things like that with that money at that point in time.
Yeah.
Now the money flows back into the economy at that stage.
Yes.
Yeah. It's
so that's I think we've just recorded a podcast about the Dodge Ram Index, which was us, sounding like old curmudgeon saying, times are going to get hard again and things are going to be lean, and we got to all get ready to tighten our belts, and we've all got to be ready for some hard times and get ourselves in a good position. And that's true. And this now sounds as though we're saying, things are going to be okay. I guess the point, or for me, the takeaway from this is that things are never as good or as bad as what they seem, or as what they are reported in the media. So if you are getting your financial news if you're getting your financial news in any sort of traditional way, from the newspapers, from anything like that, anywhere where a journalist is being paid to capture and keep your attention, of course they are going to be able to sell more advertising if they are going to tell you about $100 billion get wiped off the New York Stock Exchange yesterday and all these kinds of things. It's never as bad as all that. It's never as bad as what it seems. In the same way that, as we said in the Dodge Ram Index, is that things are never as good as what they seem. When things are going along really well, you've also got to prepare yourself for some lean times, because things will get lean again in the future. But when we do, the Dodge Ram Index was probably about when things get really tough again, and getting prepared now and taking advantage of these good times and getting ready for that. When things do get tough again, or when things, when assets drop, when prices drop, when spending goes down, when we do enter another recession, it's again, the point here is that it's never quite what it seems. It's never quite what it's reported. Things don't stay good or bad forever. Things come back to their natural equilibrium over time.
I've got nothing to add. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. We look forward to catching up again soon.